Welcome to the captivating, sometimes chaotic world of the stock market. It's a place where fortunes can be made and lost, driven by a complex interplay of factors that cause it to surge with optimism one moment and plummet with fear the next. Think of it as a massive global auction house where pieces of companies' stocks are constantly being bought and sold.
Look at it go! Another record high! This feels unstoppable!
When the market is on the rise, it's often fueled by positive economic news. Low unemployment, strong company profits, and confident consumers all contribute to what's known as a bull market. It's a period of optimism, where investors are eager to buy, driving prices higher.
Major economic indicators released today show robust growth, exceeding all expectations. Corporate earnings are strong across multiple sectors.
It's a good run, but remember, what goes up can also come down. The market isn't just about numbers, it's also about sentiment.
And that's where the human element comes in. Investor psychology plays a massive role. Greed and the fear of missing out can push prices to unsustainable levels during a boom, but just as quickly, that optimism can turn to panic. Several forces can trigger a market downturn. Bad economic news like rising inflation, increased interest rates, or a slowdown in growth can make investors nervous. Geopolitical events, natural disasters, or even a company-specific scandal can also send shockwaves through the market.
Concerns are growing today as inflation figures show a significant increase. The central bank is now expected to consider raising interest rates.
What does this mean?
It means uncertainty, and the market hates uncertainty. When fear takes hold, selling can accelerate, leading to a bear market, a period of falling prices.
History is littered with examples of these dramatic shifts. Moments when the stock market didn't just dip, but crashed, with devastating consequences that rippled through the entire economy. These aren't just lines on a graph, they represent real hardship and profound change. One of the earliest major panics in the United States that highlighted the fragility of the financial system was the Panic of 1907. This crisis was triggered by the failure of the Knickerbocker Trust Company, leading to a run on banks as people lost confidence. The stock market plummeted by nearly 50%. It took the intervention of financier J.P. Morgan, who gathered other bankers to inject liquidity into the system to prevent a total collapse. This event underscored the need for a central bank, eventually leading to the creation of the Federal Reserve.
They say the banks are failing. We need to get our money out now.
But perhaps the most infamous crash, the one that became a symbol of economic despair, was the Wall Street crash of 1929. Years of speculative frenzy, where stock prices soared far beyond the actual value of companies, created a massive bubble. When it burst in late October 1929, the market experienced a cataclysmic collapse. On Black Tuesday, October 29, 1929, a record 16 million shares were traded in a desperate wave of selling. Fortunes vanished overnight.
Everything, it's all gone, my life savings.
This crash didn't just affect investors, it was a major catalyst for the Great Depression, a decade-long period of severe economic contraction worldwide. Businesses failed, unemployment soared to unprecedented levels, and widespread poverty gripped nations. The stories from this era are heartbreaking: families losing their homes, people searching desperately for work, the basic fabric of society strained to its breaking point. It taught a harsh lesson about the dangers of unchecked speculation and the interconnectedness of the financial system and the real economy. Fast forward to the age of computers and global interconnectedness. Black Monday in 1987 showed just how quickly a market could fall in the electronic age. On October 19, 1987, the Dow Jones Industrial Average plunged by over 22% in a single day, the largest one-day percentage drop in its history.
The machines, they're selling everything. We can't keep up.
While the exact causes are still debated, factors like programmed trading, where computers automatically sold stocks as prices fell, and a lack of liquidity in the market contributed to the speed and severity of the crash. Unlike 1929, the global economy didn't immediately descend into a depression, partly due to swift action by central banks to inject liquidity. The late 1990s saw a new kind of bubble, the dot-com bubble. The rise of the internet fueled massive investment in technology companies, many with unproven business models and little to no profits. Stock prices for these dot-coms reached astronomical levels based on speculation and hype.
This new internet company, Pets.com, is going to change everything. Their stock can only go up.
But by early 2000, the reality check arrived. Many of these companies were burning through cash without a path to profitability. The bubble burst and tech stocks plummeted. Companies folded, and investors who had poured money into these ventures lost heavily. While painful, the bursting of the dot-com bubble also cleared the way for more sustainable technology companies to emerge and thrive. Just a few years later, the world faced the global financial crisis of 2008. This crisis had its roots in the U.S. housing market, specifically in subprime mortgages loans given to borrowers with poor credit history. These risky loans were bundled together and sold as complex financial products around the world.
These mortgage-backed securities, the risk isn't being properly understood.
When the U.S. housing bubble burst and borrowers defaulted on their mortgages, the value of these financial products collapsed, severely impacting banks and financial institutions globally. The crisis peaked in September 2008 with the bankruptcy of Lehman Brothers, a major investment bank. The stock market crashed worldwide as the financial system seized up. The ensuing Great Recession saw a significant rise in unemployment, foreclosures, and a sharp slowdown in economic activity. Governments and central banks had to implement unprecedented measures to stabilize the financial system and stimulate their economies. More recently, the COVID-19 pandemic in 2020 triggered another sharp, albeit brief, stock market crash. As the virus spread globally and economies shut down, uncertainty and fear gripped the markets.
Markets are in free fall today as the coronavirus pandemic intensifies. Economic activity has ground to a halt in many sectors.
The speed of the decline was alarming. However, unlike previous crises, the market also saw a relatively swift recovery, largely due to massive fiscal and monetary stimulus from governments and central banks, as well as the unique nature of a crisis caused by an external health event rather than fundamental economic imbalances. These stories, from the panic of 1907 to the COVID-19 dip, highlight a fundamental truth about the stock market. It is cyclical. Booms and busts are part of its nature. They are driven by economic fundamentals, but amplified by human behavior, by waves of optimism and pessimism, greed and fear.
It's a constant reminder that investing involves risk. You need to understand the potential for downturns and have a long-term perspective.
So it's not just about picking the right stock, is it? It's about understanding the bigger picture.
Exactly. While past performance is no guarantee of future results, studying these historical crises offers valuable lessons. They show the importance of regulation, the impact of global interconnectedness, and the powerful influence of human psychology on financial markets. The stock market symphony will continue to play, with its movements reflecting the complex rhythm of the economy and the ever-present human element. Understanding its history is key to navigating its future. Thank you for watching. Don't forget to like, share, subscribe, and comment for more.